Hello and welcome to the Harwood Report for January 8th, 2019. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. Let's start with the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read through the rest of these disclosures and then we will get to the charts. All right. So we're going to talk a lot about equities because equities are really changing up again. So, it's been a couple of weeks since we've done the free video. I've been doing the premium product for subscribers for the last couple of weeks, but, taking a little break during the holidays for the free stuff. And I want to revisit what's really changed for all of you guys over the last couple of weeks as a result. So, we've got a lot of time period to cover. And so with that, I'm going to try to get straight into this guy right here. First off, fear and greed, really low. It's higher than it was a week ago, 12, a couple weeks ago, it was down to 6. So you can see that real low down there that happened a couple weeks ago. When we get these bounces, we tend to see at least a move towards the 30. So we're not, I don't think, quite done yet with the bounce. We may not go straight to 50 or higher, but I think there's a little more rally to come, barring some fundamental update about China that is negative. We haven't had any real updates right now. The clock is ticking on our 90-day window. I expect a deal to get done. I expect to hear progress coming through. But at the end of the day, headlines can really put, a problem in front of the market. Or headlines can help them spike back up and make new all-time highs, depending upon how this whole China deal works out. Let me go through some of the individual indicators because I think these are all still important. The VIX is very neutral right now. That's probably telling me that, the market doesn't need hedges right now. So a lot of people got out of the market rather than hedging their positions. There was a lot of actual selling of ETFs as a way to hedge portfolios, shorting SPY. There's a big short interest there now. I think that you've also started seeing some trend followers building that short. That actually creates more of a potential for, I think, a spike in the indices. When we look at the put-call ratios, they're coming down to more relatively calm levels after spiking drastically at the end of December. You can also see that the safe haven demand thing is starting to kind of peter out. The yield spread spiked and is coming back down towards the lows. This guy is really where, these two are the ones that I think I care about a lot right now. We have massive numbers of stocks making new 52-week lows, and we've actually had a situation now where there are more stocks close to 52-week highs than really close to 52-week lows when I look at some of the metrics that I look at. We got really oversold in December. If this starts to flip up, and moved back towards this line right here, kind of the low in October, and then even back towards zero, we're going to see some major buying. And I think that has to come, though, with a fundamental update to get to above zero. We can get to here without it. So we're not seeing all of this stuff get to the levels that I think we can get to without a fundamental update. So we can get here without a fundamental update. We can get here without a fundamental update. And when we look at the charts, I think we can get here without a fundamental update. Here a couple things that I really want to focus here on S&P. So we had the major low on December 24th, Christmas Eve, low liquidity day. The following Wednesday, we spiked and started squeezing the shorts. We had a bad update from Apple that made us look like this was just going to be a quick bear flag and it's all over. And then Powell came in and talked dovishly enough that the market said, you know what, there might be a Fed put below the market. Let's go ahead and press back a little higher. This doesn't need more bullish inputs in order to get there. This can happen just off of momentum, just like this happened off of momentum without new updates. So we had shorts adding to positions. Now I think we get shorts covering positions. How many days in a row did we go down? 1, 2, 3, 4, 5, 6, 7, 8 trading days in a row. We're on day 3. Maybe you could call it day 5 if you want to kind of add a couple of these ones in the back because we had a couple red bars in there. So what we're saying is we've got more time to run if the short has to cover and if the long wants to build. Remember, December issues also come with end of year marks. Hedge funds don't want to buy here, see the market drop 10% and destroy their entire year's returns if they had any. That's what leads to redemptions. When do they have time to build up positions and recover from mistakes? In January. So we get into January and we can recover from mistakes because you got a whole year to make up for it. If you make a mistake at the end of December, you're out of time. because on December 31st, the books closed for the year. All right. That, I think, was part of the driver for the big liquidation event. That, though, also may have built up short positions in algorithmic and trend following systems. We are now above the 10-day moving average. We have a sharply upward sloping 10-day moving average. We are above the 20-day moving average, and that slope is fading. We are closing in on the 50-day moving average. I know it's still 3% away, but we're seeing those kind of moves over the course of 1 to 2 days. The MACD is showing a bullish divergence really starting on December 31st. So we've got a lot of signals that tell us that the trend is flipping, that the trend may go up, and then around either the 50-day or, more likely to me, the 200-day, we find out where the power is in this market. We also can tell here, for just one note here, that the previous resistance, these 3 times at 280, is now above all the moving averages. So if we're going to test that level, we're going to have a lot of trend following systems that use moving averages saying we need to get long. I don't think this can hold if we get above all the moving averages. More likely, this 200 and 100 or 100-day moving average will be a more crucial element of resistance if we get there. Let's go to the VIX. The VIX is falling. It is down to levels of mid-October. So the market is telling us that the fear level is around where we were in October, but the price level is not where we were in October. Keep that in mind. There's less fear on the recovery, but there is still some hedging. We know that people have been fooled. So what are they doing? I'm expecting that you've got some people that are towing back into the market, probably looking at hedges. So while we're recovering, if shorts are building in SPY, it's because people are adding longs in individual names, but shorting the market as a hedge. That helps set up that explosive move to the upside, because then people eventually have to cover their shorts. Especially when you see the VIX dropping down towards, like, say, 17 or all the way back here towards 16.5. Again, we've seen these falls. They tend to find support down here on the 200-day moving average in the VIX. Not that I'm a huge fan of technical analysis on the VIX, but this is another indicator to me that we have a little bit of room to fall in volatility and prices to rise in equities. If I go to the Qs, so this should be in the worst shape, right? It had the bad Apple update. Looks basically the same as the S&Ps. Everything is fine here. Chart-wise, it looks good. Remember, this had that downward slope. We're looking for that to basically take out the 50-day moving average and then start to worry about this slope here. So you see this slope. That's the resistance above there, and that's going to be below the moving averages. The one thing I always like to look at with the Qs is SMH, just because it's an early indicator. And SMH is basically the same as all of these other things. Remember, all these equities, when you get a big liquidation event, the correlations tend to go towards one. But one sector that has really spiked, because there was a Bristol-Myers for Celgene takeover a couple days ago, is biotech. So you see that biotech is in the middle of that October-November range. So this has really outperformed here, as I think people are looking at biotech as a sector that may have found value. We're above the 50-day moving average. We don't see that in big indices like the Qs and the S&Ps. IWM had been the leader of the market on the way down, and now it's closer to the 50-day moving average than the rest. So it's still got some recovery to go to get into the range, but it is starting to cross moving averages a little bit quicker than S&Ps and Qs. Again, showing me that maybe some of that short is covering. Those guys that are following the momentum might be looking to cover, and they might need to continue. I think they will need to continue. We talk about the trades on these, by the way, in the actual Harwood Report newsletter that I published yesterday, talking about how to capitalize on a market that rallies to an obvious resistance point and then stalls. So if you want to get more information about how to make that kind of trade, you got to sign up for the premium product. I'll show you a link at the end again. And remember, the premium product, I give you a week for free. So there's no real risk to you to signing up. I want to move to TLT, because bonds are trending higher, and you can see the obvious support here. It's at the 10-day moving average. Now, if the Fed is telling us that if the market goes into a bad situation, it's not going to raise rates anymore, basically they're telling us that these yields that drove prices down towards 113, 114, 115 may be unsustainable, and maybe that's off the table. So I think right now what you're seeing in bonds is maybe not necessarily bullishness, but probably not bearish. I don't think we can get below 118.5 very easily. That's been previous support, and it really lines up well with the 200-day moving average. It's going to be tough to push down below here. So what do we see? The 10-day moving average is holding. If that breaks, you get a small breakdown towards 120.5. If that breaks, the breaks down to 118.75. And then again, this day I kind of ignore because it was such a big spike, and that was all Apple kind of driven. But if we start getting above these levels here, you can see them. The previous highs here around 122.87. That could cause a spike up towards 126, 127 range. So, these are kind of just the levels I'm looking at in bonds. I think bonds are just going to kind of trade counter to equities, but with a little bit of a floor. So I think both bonds and equities have a little bit of a floor based upon what Powell did. But they don't necessarily need to trade hand in hand like they did in 2017, where risk parity funds were all the rage. So everybody's buying bonds and buying stocks and driving both prices higher. I think you just have a situation where if they get cheap, if either gets cheap, they find a floor. They both find a floor. And right now they're not near those floors. Let's move on to gold. So first we'll start with the dollar index. Oops, DXY. There we go. So the dollar index really starting to look like it might roll over. It broke below the 100-day moving average. It may find support at the 200-day moving average or on the September low, which also kind of coincides here with the July low. Okay, so I think that today's bounce in the dollar is nothing to write home about if you're a dollar bear. I think we've got a little more move down in the dollar to go. In particular, I think dollar yen is showing signs of being super bearish. This reminds me a little bit of the way oil broke. So we can't even get back to the 10-day moving average here. Yeah, we're oversold. So what we're doing is similar to when we were in 2017 waiting for moving averages to catch up. We stall for a few days and wait for these moving averages to catch up to this bearish dollar yen action. That creates a potential for a little bit of a stall for a few days in gold and silver. And so what we're seeing is gold having a little pullback, but it looks a lot like bonds, right? Using the 10-day moving average as support. Not a lot of bearish reason to be bearish in gold right now. I think there's reason to be bullish, and I think there's reason to expect a potential for this kind of move. Back up towards 127. Over time, though, I think this week is probably just a hangout week. SLV similar. We may just hang out for this week, but SLV could easily get up to its 15.5. So all of this stuff is waiting for moving averages to catch up to the move that already happened. The market got a little bit ahead of itself in the precious metals and commodities in general. So we wait a little bit for the whole market to kind of say, okay, well, we needed to get to this price. We just did it faster than we needed to. So let's wait a couple days, consolidate, have some positions change hands, and then we can resume the uptrend. Finally, I want to talk about the oil name. So oil, as you can see, is recovering. It's finally above the 20-day moving average. It's a lot like stocks in that perspective, except for this was so much more bearish than stocks. You saw it just basically ground down with the 10-day moving average. Tried to show a little sign of support here in early December and then just fell out of bed. Now it's starting to come back alive. It looks good. I think we get to 11 pretty quickly here. That's my initial stall point. Then we wait for a couple more of these moving averages, these guys to pull down and these guys to move up to create a natural coil. Okay? So as these moving averages converge on each other, that creates the coil effect. And then that's why I'm looking at XLE as a stock that can, or an index that can easily get to 65, but probably stall. And OIH, we're looking for around 18-ish, 18.5. And then that's my stall point there. So you see these like natural stall points of where we were late November, early December in a lot of these indices. And I think that's what we need to start thinking about. And that's how I'm going to approach these markets, is to think about how we get to that late November, early December level where we had a lot of stability. And then what happens after that consolidation period ends. So right now I have to have a bullish bias because of the way that the market is behaving. It's telling me that bullish bias is right. We should have a little bit of a squeeze. If any fundamental update comes out, that's going to drastically change the entire technical picture. But right now, the technicals say higher, and lack of update allows us to drift higher. That's the general thesis here. All right, folks? So I talked about the Harwood Report, the premium product. You get your first week for free. After that, it's only $49 a month. That's where I talk about actual trade concepts and how to pair this technical bias with an actual trade. And then on top of that, I do another midweek update. So everybody gets an extra video and a nice long newsletter talking about how to actually implement a trade on these technical biases. So you get a lot more education there on the actual option side of the world. Feel free to email me, keith@tradeacademy.co. I include my phone number as well, but the easiest way to get a hold of me is always on email. Thanks again, folks, and we'll touch base next week for those of you that are sticking with the free stuff. But as I say, try out the premium product. I don't think you'll be disappointed. Thanks again.